where did you start your career?
Believe it or not, I actually started working in the biomedical industry, writing software for a company that was building heart pacemakers, bionic ears, and other pretty amazing technology. My early financial markets career actually started in London in the market data space for Reuters. That took me through Deutsche Bank in Frankfurt and back to Sydney, working for Australia's largest telco, Telstra, and then later for Nokia. I got to use some pretty cool cutting edge technologies.
And how did you transition into retail effects then?
Doing some consultancy for a smallish broker in Sydney. And when I first came across the space, that was sort of around 2013, I was pretty horrified, to be honest, by the immaturity of the technology that was available to brokers. There was no proper risk management, with brokers usually relying on some primitive in-house tools. Really quite humorous now when we look back on it.
Can we just briefly describe the functionality that you went to market with, like in terms of risk management?
The platform that we initially put together was really to provide an integrated view of risk and to really allow them to start to warehouse some of the flow that they had. The first system, the core of it, pretty much did what it does today. As we went, we quickly started to add a whole array of functionality.
How much data do you store? How do you process it? Must be incredibly expensive.
Yes, we do take in a lot of data. We pull in account data, trades and pricing, and that's enough to let us do full position exposure management, complex trader surveillance.
Speaking about the big data processing, are you using any AI in your analytical tools? We see a lot of brokerages coming into market and leaving within a short time frame. You, as a veteran of the industry, what would you advise to those founders and basically those startups that are coming into the industry?
Well, I'll give you one critical point, and that is don't think of risk management as a cost, but as an opportunity.
Tom, could you give us the key metrics, the key criteria that you personally consider important in order to evaluate the flow and to break it into the retail and non-retail?
Welcome, everyone, to episode 5 of Dealers Connect podcast series, presented by your humble hosts, Garanin and Elina Pedersen. Today, we're joined by Tom Vasak, co-founder and CEO of Tapas, trading analytics platform as a service. Tom has decades of experience in quantitative research, software architecture, and trading systems, especially when it comes to making the big data work for you. Today, Tom will share some of his knowledge and experience with us. Welcome, Tom.
Thanks for inviting me to your podcast, Elina and Roman. I look forward to sharing some of my insights.
Well, it's a great pleasure to have you. And we had some conversations already. And I think the amount of knowledge you have in regards to risk and analytics in general is just incredible. So do you mind sharing with us, where did you start your career?
Sure. Believe it or not, I actually started working in the biomedical industry, writing software for a company that was building heart pacemakers, bionic ears, and other pretty amazing technology. One of the projects that I worked on was a cancer treatment device that focused ultrasound beams inside the body to heat stress and kill cancer cells, leaving normal tissues unaffected. We had lots of fun doing the QA. I'm sorry?
Is it still running? Is it something that people use as a treatment?
I believe it evolved into something else. We had lots of fun doing the QA for that project. We used to go and buy thick New York cut steaks, and part of the testing was to cook the inside. Didn't look particularly appetizing.
Well, sounds fun. Okay.
So anyway, I mean, that's a long way away.
How did you transition to finance from that?
Very different. That's miles away from financial markets. My early financial markets career actually started in London in the market data space for Reuters, building parts of what was known as Triarch. That was Reuters' early market data platform. That took me through Deutsche Bank in Frankfurt and back to Sydney, where I decided to have a bit of a stint in the telco world, working for Australia's largest telco, Telstra, and then later for Nokia. Whilst at Telstra, I worked on building intelligent phone services and wrote the world's first Java-based smartphone exchange in 1995. That was pretty early days for Java. While at Nokia, I worked with some of the world's earliest mobile apps. Not sure if some of your listeners are old enough to remember the clamshell-style Nokia communicator. That was what we were actually using. Anyway, from there,
I still think that Nokia like 3310 was probably the best phone ever invented. I guess there'll be people who will disagree with me, but I used to love that phone.
Yeah. There's a lot to be said for that early design.
Yeah.
So anyway, from there I moved into the capital markets world, looking initially working with Salomons, which ultimately became part of Citigroup. And there I worked building leading trading, risk and analytics platforms in the institutional space. Over those 15 years, I got to use some pretty cool cutting edge technologies and built some really great platforms. And I got to understand the institutional market space extremely well as well. So together with the experience building 24/7 telco systems, together with that, it was a really great mix.
And how did you transition into retail FX then?
Well, I first came across in the retail space, I came across doing some consultancy for a smallish broker in Sydney. And when I first came across the space, that was sort of around 2013. I think it was 2013. I was pretty horrified, to be honest, by the immaturity of the technology that was available to brokers. I won't deny that. It was, there was no proper risk management, with brokers usually relying on some primitive in-house tools. Most often they were running at end of day to tell you, what happened the previous day. Like, how much did you lose? There was
no
generally
real
what they
time,
had.
was there? It was just like run the spreadsheets and have a look.
Well, there was a couple of more sophisticated ones that would sort of take dumps every couple of hours, and they would sort of connect up, dump some information, and then you'd sort of look at how things were, at the last snapshot. So that was deemed to be real-time risk back in those days. Really quite humorous now when we look back on it. So set against this background, I teamed up with a former Citigroup colleague named David Hall. And what we decided was to make it our mission to bring some of the risk and analytics technology that we were so familiar with from the insto world to brokers in this particular market segment. So that was essentially, the genesis of Tapas. So you might ask, what is this technology that I'm talking about? What are the key technologies? And I've sort of introduced some of that to you. I mean, at the very core of that endeavor was building a platform based on KDB. KDB is the world's fastest time series database, and it's in use by virtually all of the top tier institutional trading players. So it's something which sort of is a given, essentially, if you're doing this properly. It provides unmatched capability to deliver computationally really intensive insights to a risk manager. Other technologies, from a user experience perspective, we wanted to bring the power of business intelligence dashboarding to the user, and in particular, leveraging a tool like Panopticon. This combines really rich visualization with broad flexibility for users to navigate their data, to absorb what they're looking at, and to act upon the insights. So after a pretty intensive 6-month development, we rolled out the first Tapas version to production at the start of 2015, a full 2 weeks before the SNB currency peg incident, which was nice timing. And that was certainly a great first up test with the fledgling platform, and we passed it with ease. So
can we break down, sorry, Tom, can we just briefly describe the functionality that you went to market with, like in terms of risk management?
So let me give you some insight into that. Our first client was a relatively small broker called IC Markets.
Tiny.
Well, probably call them tiny. They were they had a couple of MT4s at the time. They wanted to start warehousing, and they were prudent enough to know that they didn't have sufficient oversight over their risk across the estate. And when I say the estate, it was maybe 3 or 4 MetaTraders. So the platform that we initially put together for them was really to provide an integrated view of risk and to really allow them to start to warehouse some of the flow that they had. So that was sort of the initial thing. We had the same dashboard technology that we were using, but obviously far less developed in terms of the dashboard richness that we were offering. But by and large, the first system, the core of it, pretty much did what it does today. As we went, so we quickly started being pushed to add a whole array of functionality. Initially, functionality to discover toxic clients, to add operational aids like real-time trade reconciliation to detect out trades, then trading capabilities for hedging, and then lots and lots of other stuff like complex risk metrics, a whole family of VAR measures and scenario analyses, operational insights into pricing, critical metrics like decay analysis.
Basically, you've built a complex tool and you entered the market, because like what you're describing now is actually quite a bunch of the functionality, right?
Yeah. So our goal was to essentially satisfy the needs of the brokers at the time, but we had a vision of what we needed to do and what we wanted to do. And that's effectively where we pushed the platform, guided by what our clients needed most. And so as we brought on new clients, they would tell us the stuff that was really critical for them that we perhaps didn't have at that stage. And that's what we used to prioritize how we rolled those particular features out.
Do you mind just for me to step in and ask one question just for clarification for our listeners? Because, well, some of them would know, others may be learning. For example, you've mentioned VAR, value at risk, and decay analysis, also known as Markouts. Could you please explain what it is, how you do it, and what's the value to the brokers of having that metric?
Sure. So value at risk, there's actually many different methodologies for calculating it, but it represents essentially a lower bound on the loss that you're likely to make on a particular portfolio. And the way that you calculate that is really by looking at, I mean, you can do it parametrically by, looking at things like normal distributions of volatilities and so on. And you can compute it that way, or you can compute it through historical data where you can actually use real historical returns. And ironically, the parametric approach is actually not the best because it's a well-known fact that distributions tend to be in the markets, distributions tend to have long fat tails.
Mm-hmm.
So they don't really quite fit a normal distribution curve. So what that basically lets you do is, given the portfolio that you might hold, for instance, in your warehouse, it gives you some sense of essentially the likelihood that you're going to lose a certain amount on that. And it's really driven by a couple of parameters. There's an alpha parameter, which basically is sort of like a percentage confidence, if you like, 95 or 99% commonly used values.
Yeah. In statistics, of course.
And effectively, what you're looking at there is value. It'll come out with a value which is like the minimum. So if you visualize like a curve, essentially with the distribution, then draw a line essentially at the 95% level, and then where that actually falls in real money terms, in terms of the value of that, is actually the minimum amount that you're likely to lose. You may actually lose more than that because of those fat tails, those.
Is it like a positive skew or negative? So obviously, just again for the listeners, a standard distribution is a bell curve you see in statistics. And please, Tom, correct me if I'm wrong, because my statistics are really, really rusty. There can be a positive or negative skew to the data. So it may be to one or the other side. Am I explaining this correctly?
Yeah. Although it's more about the actual shape. So the shape is probably a little bit like someone sat on the curve and squished it out a bit.
Okay, got it. Fair enough.
So it sort of reaches out a little bit more. And so some of the metrics that are in the VAR family, essentially they compute this conditional VAR, which is basically computing effectively like the average under the curve of, it sort of gives you more of an average of how much you might lose. So these are sort of metrics which the real numbers are somewhat misleading in the sense that, if you've got a warehouse and you're going to lose quite a bit of money on it, then it's going to become evident. You're not going to hold it for a full day to expose it to the full movement that you might get. You'll start to act fairly quickly. So in a way, it does always represent sort of a worst case in some respects. But we've certainly got a number of brokers who base their risk management prudential sort of model on it in terms of just how much they're allowed to take, how much risk they're allowed to take, and when they have to start shedding some of that.
So do I understand correctly that this data is important for you to, first of all, understand how much capital you need to be able to sit on that exposure, and also to make a hedging decision to capture the highest dollar per million?
Yeah. I mean, the first point you brought up, it's really around the other way. I mean, really,
Okay.
your risk management policy, probably ordained by the board, would govern really by the size of your balance sheet.
Yeah, of course.
That would really
You are a regulated
determine
broker.
how much risk you're allowed to take. And then you would really translate that into, you'd be measuring that risk perhaps with a VAR measure to sort of say, well, I can't afford to take a loss any bigger than this. So I've got to start to do some hedging. And so some of the stuff we provide there as well is some hypothetical scenarios where you can actually do some hypothetical hedges and just see how that impacts on the actual portfolio. Because it's not really, these instruments don't act in unison. I mean, what's really important with VAR is that there's correlations between certain instruments to certain degrees, or inverse correlations. So often making a particular hedge will actually have a significant impact on the actual value. So it's sort of quite important to be able to do some experimental scenario type building. So that's VAR. And as I say, there's many variations. I think we support at least a dozen different variations. And then there's decay analysis.
Before we move to decay, sorry, Tom, just a question from my side here. Before we move to decay, regarding VAR, it has been for a while on the market, and it has been quite an arguable tool for the retail broker. And I would just like to hear your opinion in terms of VAR. Basically, it measures your current exposure, right? But we know that retail behavior is subject to change very quickly due to the stop losses, due to over leveraging, due to the stop outs and stuff and so on. And basically the exposure may be changing quite significantly over short periods of time. Do you guys, first of all, calculate this in the VAR calculations, or do you consider those metrics and variables?
Yeah, the applicability of VAR, I mean, it has its proponents and people who rightly point out its limitations. I think really the best way of looking at it is it provides a measure of risk. The actual absolute value of what comes out of it may not necessarily be sort of relevant in absolute terms, but it's a needle on a chart that's telling you an amount of risk that you're actually holding at the moment. And so that's really important because, you start to get to know what your settings are when you're getting into high numbers. And just because you've hit a VAR of 5 million doesn't mean that you're going to lose 5 million. But in relative terms, if you're basically used to running in a sort of a 2 to 3 million, then it's going to be quite significant. The other thing is also just gapping across weekends, for instance, and maybe some holidays. That's also pretty critical as well. There's no end of volatility in the markets these days, and a lot of that could well happen over a weekend. So, you might say that you'll never experience essentially, a movement like that, because you may decide, as soon as you start seeing the price going the wrong way, you'll start to take an action. But the reality is that, you do have those gapping scenarios, and you're quite likely to cop a fairly nasty shock come Monday morning if there's been some significant, geopolitical events or whatever else.
All right, let's pass to the spread decay. Could you give us some definitions from your side, please?
Sure. So in really high level terms, decay analysis, what does it do? It looks at the trade that a trader has done, and it looks at the pricing behavior around the point of trade. And when I say around, really that's a configurable thing that the dealer can select. They might be looking at sub-second, they might be looking at multiple seconds, they could be looking out to a couple of minutes. And the importance of that is really in seeing essentially where the price evolves to after the relevant trader has actually placed their trade. Now, when you start looking at this stuff, a single trade is interesting, but doesn't really tell a story. What is interesting is if you start to look at this in a statistical fashion across a range of trades the trader is actually placing. And when they do that, then you'll start to see some patterns potentially. I mean, if, for the average trader, you probably won't see too much. There'll be some trades that were lucky, some trades that were unlucky, and some trades that sort of didn't really matter if they happened then or some other time. But occasionally you'll start to see some clustering of values. You might see that somebody is actually doing a trade at a very opportune time, and it's happening on a very large proportion of their trades. And that's really where you can start to sense that perhaps there may be some latency arbitrage at work. There may be, it's, there's a number of different scenarios there which come about from this sort of statistical analysis of a particular trader's trading behavior.
Sorry to interrupt. What percentage of winning trades would you usually say, well, this looks suspicious? I know there's no easy answer, but
there's no easy answer. I think, in general, you'd expect somebody to sort of be 50-50. I mean, when they're sort of starting to get...
Fair enough.
If they're 100%, obviously there's something going on there. If they've done enough trades, they can do 100% and have done 3 trades, and that's still within the realms of possibility. If they're getting really high percentages like that, even in the 90s, you're starting to become pretty suspicious. And that's really where you start to look at the trading volumes that they're actually doing and what symbols they're actually trading. So, if you suspect that they're trying to perhaps attack a particular symbol because they feel that they have a pricing advantage, by way of a feed from another broker, it'll start to fall into place when you start to look at the distribution of these trades and where they're placed, when they're placed, and even down to the volumes that are actually being done. A lot of potential traders that want to engage in some of this sort of, say, latency arbitrage would tend to go through like a, what would I call it? It's a little bit like, when you got somebody who's port scanning you on the internet and they're probing for weaknesses. Mm-hmm. So that's essentially what they would be doing. They would be probing for can they do a little trade, and how do they fare? Is it easy to basically make a profit? And they'll try and keep under the radar by actually doing trades that are not significant. So from a P&L perspective, it might not look like anything, but that's again sort of where Tapas has a lot of detection algorithms outside of just the decay analysis. We have specific algorithms that are looking for that sort of vulnerability analysis that might be going on. When you translate that back into decay analysis, it becomes interesting because there you'll see, the percentage of successful trades may be quite large. The P&L may be quite small, but, once they've recognized that there is an opportunity, that's really when they're going to start to hit. So
that makes sense. Sorry to interrupt. I'm just excited.
No. I was just finishing up.
So a lot of those things, and I mean, I know that VAR or spread decay, markout is just parts of your functionality, and you have a lot more than that. From my experience, just doing VAR and even spread analysis, that requires a lot of data. Like, it requires big data, right, to be able to plot it. So how much data do you store? How do you process it? Must be incredibly expensive.
Well, yes, we do take in a lot of data. Really, we can work with all sorts of different configurations to suit specific broker needs. Obviously, the more streams of data we can ingest, the more functionality we can make available. In the simplest case, we just connect to the trading platforms. We pull in account data, trades, and pricing. And that's enough to let us do full position exposure management, complex trader surveillance. We call it trader surveillance really for a lot of the alerting that we have. We're looking out for various scenarios. We're looking out for various behaviors, and that's really critical for most brokers that use Tapas. But for that, yes, we do take in a lot of pricing information, all the trade information, and there's a lot of computation really to, if you look at things like VAR, for instance, we don't just compute VAR for the broker portfolio, the warehouse portfolio. What we also do is we compute VAR for individual clients as well. And that's also quite illuminating sometimes to show up, certain risky holdings and risky trading strategies that people may have.
Would you say, so all of that information, right? And the simplest integration with just extracting that from the trade platform. I know you can do a lot more than that. I know you can be really integrated into all the processes. But so this first approach, would that be more of an eyeballing approach where the dealer be like, okay, this account that, and now I need to move that person over from one book to another? Or is it still quite automated?
No, look, a large part of Tapas is built to be completely automated, to automatically act upon detection of certain toxic situations. So when we say act, it generally means switching traders automatically between books. And we can do this through two ways. We can do it through group changes. So if somebody is routing based on group names or whatever, then we can set up rules to move clients, say, between B book and A book. Or we can actually place routing rule changes directly into bridges to impact things. So essentially, we can do that, but we can do a whole lot more. If you even just with the level of integration that we've discussed, if you give us a trading connection, then we can automatically hedge so once we've moved a client, there's residual positions that really need to be hedged out. And we have capabilities to be able to hedge those out through algorithms, through a trading connection.
I think that's where Bridge and Tapas cross over, because we could do that as well, but it's a lot easier when someone like you does it,
Well, yeah, I mean, what we basically do, and this is something which maybe people don't really understand, is so we ingest the rules that are used in the bridge. The bridge generally uses it to place trades. So, when somebody places an order, goes into the bridge, gets evaluated, bridge says, I'm going to send it to an LP. I'm going to internalize it. I'm going to do whatever I'm going to do, split it or something. Whereas what we do is we apply those rules, exactly the same rules, but we apply them to positions. So at any point in time, if you were to change the rules, then we can go and have a look at all of the positions that are currently open, and we can effectively rebuild how they should be allocated between A and B book to match those rules. And then there's a certain amount of hedging exposure that's left. Ideally, some of that, if you've changed a few things at once, some of that might net off. We have algorithms that actually have optimized really for netting. So they'll hang back unless a certain threshold is available. And then once you sort of hit that threshold, they will then look to execute in the market and at the LP and do that in a manner that doesn't push the prices around too much. So, there's an algorithm there which can slice the order flow up.
All right. Speaking about the big data processing, do you guys using any AI in your analytical tools? And if yes, then could you give us some use cases?
Sure. Yeah, we have some ML projects that are currently underway at the moment, and we're starting to also work with brokers on some machine learning initiatives. We actually started working with investigating ML as far back as 2016, but the tools that we were using then were pretty primitive, and we finished up coding our own neural network implementations from first principles, which was fairly unsustainable. Obviously, the world has moved on, and there are significant enhancements in terms of the tools that are available now, which makes ML a lot more accessible. By using KDB as our underlying database, we really find ourselves pretty ideally placed to apply various ML techniques. In terms of how we engage with brokers, I mean, this is sort of a bit of a sensitive topic. I mean, obviously some of the brokers may have a feeling that they sort of have some secret sauce, if you want to put it that way. And so they'd like to be able to do some machine learning, but not necessarily share it with others. In other cases, they're happy to sort of progress and get an implementation. So the whole sort of, is it proprietary? Is it shared? It's an interesting topic. And for us, it's really a question of the funding of how we actually agree to work on those enhancements. If we bear most of the costs, then really we're looking to recoup it and make it available to other brokers. But if a broker wants to retain their IP, then they can certainly fund more of that effort. And, ideally there's some sweet spot there where we can extract some generic tools and knowledge, but they don't really divulge their secret sauce. Another possibility that we're also open to is for brokers who want to keep a tight lid on some of their ML developments, is to directly utilize the complex data set that's maintained within Tapas, but to actually apply their own techniques to it. So as you can imagine, we have a really voluminous and rich data set, which, within an environment that is really particularly suited to machine learning in the context of KDB. So that's really something that we're certainly interested in brokers exploring with us.
Tom, so we've mentioned KDB a few times, so I'll just try to explain what it is. Well, KDB Plus, it's a fantastic, absolutely brilliant high performance database, and it's optimized for real-time and historic data queries in real time. So it's something that a lot of high-end tier 1 financial institutions are using as a part of their stack. But Tom, as far as I know, it's incredibly expensive. So could you please elaborate on that? I mean, who is covering the cost? Is that Tapas, or is that the broker? Or how do you, of course, the things you can do with it is great. I'm just wondering how that is managed.
Sure. So we basically, because we've been able to reach a certain scale of operation in terms of the number of brokers that we service and so on, we've been able to negotiate really quite a reasonable deal, essentially, on our KDB pricing. And we make that available to our clients through the product effectively. We do have, we charge a certain part of our fees, sort of third-party costs, and they're related to KDB. But they're a small fraction of, if you wanted to go out there and actually leverage KDB yourself, it would be prohibitively expensive. So this is really sort of, the benefit that we've been able to get to a point that we can actually negotiate at scale, which an individual broker probably wouldn't be able to do.
That's brilliant. Okay.
Let's touch back the subject of the metrics that we are following for the brokerage, just a little bit more applicable area. Tom, could you give us the key metrics, the key criteria that you personally consider important in order to evaluate the flow and to break it into the retail and non-retail categories? What would be those parameters that you are looking at?
Sure. So really it depends on, you're really looking at, let's call it toxic flow, because toxic flow is flow that hurts you. That toxic flow can be toxic to you either because of its behavior or because it has some inherent superior quality, a quality of, in terms of the decision making behind it. So the critical ones really are determining the behavioral ones. So we've already spoken a bit about decay analysis, which is really powerful, but there's lots of other scenario detection that we practice. Gives us very powerful techniques to detect toxicity. Generally we try to apply those at the earliest possible stage. Just when they become effective is really something which is up to the broker to decide just how they set some of the parameters. But they tend to be things that are looking for essentially a lot of this probing vulnerabilities, etc. So that's something which is really important in identifying behavioral toxicity. There's also, if we're looking at, you're separating out essentially things like latency, scalping, other arbitrage techniques. Also from some of the trading that's really out to just capture some P&L in a sort of manner that I would say contradicts the T's and C's effectively of the broker. So, you're looking at people that are trying to perhaps capture swap, capture bonuses, and they're using all sorts of different
trading
techniques.
Conditions, is that what I'm hearing?
Yeah. I mean, it's trading conditions, less about conditions of the market and more about conditions perhaps imposed by the broker. They'll give you a bonus, and you can have people who are really trying to make the most of that bonus, and they might even be trading with another broker to sort of cover losses and so on. So there's a whole variety of different scenario based techniques to discover toxic clients. But then you get into the toxic clients who are really good traders, and that's sort of where you're getting into sort of somebody. Well, I'm not saying that all retail traders are no good, but it gets into more higher quality trading. And for those, there's lots of metrics based around historical performance, typically metrics that are statistical in their nature, and they'd be looking at performance versus trading cohorts, and especially when they're normalized against the sort of leverage that's being used. So, you really want to weed out those clients that are perhaps abusing leverage because their performance may look quite impressive, but that they're going to come unstuck at some point. So that's essentially, I guess, what I would consider would be the way to approach that.
Okay, there is one more behavior which is very common nowadays. Last 10 years, I would say, is not as obvious for many brokers as swap arbitrage or latency arbitrage or bonus or whatever, is in fact this gold trading again during the Asian session, right? So have you faced anything? Definitely you have faced, not even asking that, but have you found the way to work with that and basically to somehow manage that kind of flow? Because what we see is that they just make their deposits and start trading very sharply, and that is not as obvious as latency arbitrage.
Yeah, I mean, a lot of this really comes down to the ability to apply your analytics across different time periods. So it's not just an analytic that gets associated with a client, but if you actually start to look at trading across a particular session, for instance, and you start to effectively constrain the metrics that you've got to the actual time that you're looking at, then you're going to start to see potentially some of those, I guess, divergences, if you want to call them that, between what returns people are seeing in certain sessions versus certain other sessions. So that would be typically something that with the sophistication of some of the dashboarding, it's relatively simple to be able to start to constrain stuff by various dimensions, time being one of them. And so that would be a very effective technique, I think, for being able to see some of this.
So you're clearly able to identify that flow. My question is, would you be able to help offset the risk of that flow, or what you advise to the brokers would be just get rid of that flow?
Look, I think it's probably a broader question. I mean, if that flow is really high quality in terms of decision making, and they're unlikely to capture or recapture those losses, then it's probably not a flow that they want to have. If it's somebody who's being successful, but again, they're sort of looking at it in perhaps an over leveraged type manner, there's every possibility that they're going to make their money back on those clients. Not necessarily on specifically that particular type of trading, but they'll get it back in another way.
Elina, would you like to pass to the future outlook section?
To the future outlook. Yes, let's go futuristic. We do ask all of our guests on their future outlook on the industry. So how do you think the risk management, dashboards, and in general risk management will change in the coming, I don't know, I want to say years, but I've noticed that the industry has been moving into more months perspectives now. So long term is a year now. It used to be 5 years, now it's a year. So yeah, so what's your prediction?
Yeah, well, it's good that you've put a bit of a time frame on it. If I sort of tried to look out 10 years, I guess I'd see people probably wearing some sort of VR goggles and being deeply immersed in displays. We're not going to get there in the next few years for that. I think what's really important for an effective risk manager is to absorb what's happening across their estate and to make really timely, appropriate decisions based on that insight. When the volatility is fast moving and you're basically under stress, this is a really tough job. So what we believe risk managers really need is they need to get some more high level contextual information. Alerts that might summarize very recent real-time trends, identify anomalous trading, even by volume or behavior with respect to historical activity. So if I know that essentially something is different over the last few minutes to what I would normally expect at this particular time of day, etc., that's a big plus. So providing that sort of contextual view, I think, is really important, together with perhaps some real-time projections, looking at where's the market heading in a very short period of time, and providing some sort of measure of what might be the range of exposures that they might have, and really trying to give them some forewarning that it's not that they're going to slam into some sort of ceiling. They might have a risk ceiling, and beyond that, they've really got to sort of start hedging flow. They want to know that as quickly as possible. So it's really bringing as much information to that risk manager, but in a more higher level form, that basically gives them the ability to make broader decisions. They've got a lot of information in front of them. It's moving all the time, especially under periods of high volatility. And so what they've got to do is really stand back a little bit and take those bigger picture decisions and get those insights. So I think if I had to sort of predict, I think, that's sort of perhaps where we'll see more happening in that particular space. Some of this requires huge amounts of real-time computation to do that. And obviously that's ideally suited to our platform. Maybe not everybody's, but I think, that would really be of benefit.
All right. Tom, we see a lot of brokerages coming into market and leaving within a short time frame. I do personally see that the biggest problem here is actually an awareness of the general maths of the business. They lack of understanding what are the revenue streams, what are the costs, and basically where are those inefficiencies. And a lot of businesses are still run by the teams with the low level of risk management expertise. You, as a veteran of the industry, what would you advise to those founders and those startups that are coming into the industry from the level of your experience? What would be those advices for those guys?
Well, I'll give you one critical point, and that is, don't think of risk management as a cost, but as an opportunity. What do I mean by that? Well, too many brokers want to treat acquiring a risk system as purchasing just a commodity item. They want to pick up the cheapest solution, some sort of a bargain. We know that the risk platform is probably the single most important key to their future profitability and growth. And so brokers really need to harness the risk that they have in a controlled manner. If you don't harness that risk, it'll take you down. You won't last very long. Armed with that oversight, really what they can do is turn that risk into something that equates to growth in profitability, growth in overall size. And in this way, the risk becomes an asset to them rather than being seen as something that you're afraid of. So, we've seen this. We've seen along the way, a lot of our Tapas clients grow from pretty humble beginnings into leading global brokers, and they've taken risk very seriously. And I'll let people extrapolate from that, whatever they will.
I totally agree. And I often say to the brokers that you could have made, 15, 20% more here. Look at it at the loss, as a loss you've made because you didn't implement, a certain rule, a certain parameter, didn't use a certain tool. And if you look at the brokers' balance sheet and their spending, the technologies are usually such a small part of what they're spending on marketing. So they spend so much money on attracting the business, but then definitely not enough of making, actually working on that business they attract and extracting the most value they can potentially extract from it.
That's exactly right. You're paying a lot of money for client acquisition, and you really want to make the most of it. And the only way you're going to make the most of it is by having the insights, controlling that risk, and as I say, turning the risk into an asset, something that can actually make some income for you, even though it looks like something that you should really be trying to mitigate.
Thank you, Tom. It's been an absolute delight to have you here. And I really hope that after this session, you'll get some requests from people and dealers to look into your system, because it is quite extraordinary what you do with the data that you can get from the brokers. Thank you so much for coming.
Thanks a lot, Tom.
It's been a pleasure. It's been a pleasure being here and sharing this with you guys.